All right. Hey, everybody. It's working. Okay. So let's be honest. We are seeing Wall Street win today. Stocks are up 1.3% already, and Main Street can't even buy a house. It continues to get worse every single month. Did you know that the bottom 50% of people in the United States own less than 1.1% of public equities? Meanwhile, the top 10% own 93%. So this does not help the middle class. And you have to ask yourself, who is the next buyer that's going to be out there who's going to be purchasing a house in today's market? And we are seeing a complete disconnect from Wall Street and Main Street. Of course, this is no new news to many of you, but let's break down what is going on and why the real estate market is changing so quickly while the stock market is hitting record highs. Let's dig in to what is actually going on. So let's move over here. Okay. And for those of you watching, can you just go ahead and drop a comment just so I know you can hear me and everything is good on your end? Let's see. For this live stream, thanks for joining me. If you could just drop a comment, make sure that you can hear me and you can see my screen, that would be fantastic. Appreciate you guys. And I'm also going to drop in my email. So if you have any real estate specific questions, you can go ahead and email me. But I'm going to go ahead and jump into the presentation today. Again, Wall Street is winning and Main Street is just unable to purchase a house. So here's what's going on. Even though the stock market is ripping today, consumer sentiment is at record low. This is the University of Michigan Consumer Sentiment Index. It's unbelievable. Inflation fears have been rising amid the Iran war. That's part of it. People feel like they're getting pushed at the pump. But the other part of it is people have a record amount of consumer debt that is holding back the middle class. So this is the worst survey from the University of Michigan Consumer Sentiment Index report since 1952. We're talking this is worse than, the 08-09 recession. This is worse than 90-91. This is worse than 93 to 75. The consumer is just completely stressed, and it's showing up big time in the housing market. And if you're just joining me right now, if you could drop a comment where you're coming from and what brought you out today, that'd be awesome. We talk about real estate in this live. You can ask any questions that you have about the market. I'm going to do a presentation, and at the end, I'll be going through and answering all the questions along the way. So thanks for joining this Friday during lunch. But here's what's going on in the stock market. It is ripping after the announcement of, the Iran war ceasefire and the Strait of Hormuz opening up and everything like that. So while the consumer side is getting rocked and we've had this supply side inflation, but now it's ripping back the other way. We're already seeing oil go down 10%. We're seeing mortgage rates are still kind of staying relatively high. It's going to be something that we're going to have to pay very close attention to because it is the number one driver of real estate is these mortgage rates. And, they're still around 6.3%. So they haven't adjusted down just yet as much as we would like to see. We saw them drop below 5.99%. And it was fantastic. We saw a massive bump in demand, and now we're back up to 6.3. So what we're seeing is that the consumer is very sensitive at this point in the market cycle to any movement in mortgage interest rates that could push them off to the sideline. So the stock market has just gone parabolic. Over the last 12 trading days, 13 trading days, we've seen the S&P 500 go up 10%. We've seen $7 trillion come back into the market within just a couple of trading days. This is basically a historic moment for the market, and there's a ton of confidence going in with the stock market, but it couldn't be more contrast of what's going on in the real estate market. And just for those of you listening, one of the things that's the issue is that the return on investment for equity for real estate, because the prices got so unsustainable and the input costs got so expensive, right? Insurance going up, property tax, all of these other factors, repair costs, the math no longer makes sense to hold a lot of single family or multifamily properties when you could buy a treasury rate and get 5-6% returns, or 4% returns risk-free, and you could get a similar cap rate for real estate. It's just not worth the amount of work to manage these assets and carry the liability on your sheet. And that's why we're seeing a rotation out of real estate and into equities, into other asset classes that people think that they're going to have a better return on over the next decade or so. And so this is no surprise that this is happening after such a crazy run up of real estate prices, over 60% here in the state of Florida, 44% since 2020 across the United States. And those are just incredible numbers that, definitely beat the inflation rate. And it's just the shelter costs have got so unsustainable that there became this builder speculation that basically drove a massive amount of supply in the Sun Belt that is now driving prices down while the demand is also at record lows. So let's dig into what's going on. So here's what happened. We saw this massive run up, obviously from the early 2000s to 2006. Again, this idea of homeownership, the ninja loans, everybody can get a loan, even strippers were getting, 2 houses. And there were a lot of speculators, and speculators are generally what cause bubbles. What we had this time was, a mass migration from the Northeast to the Sun Belt, during the 2020 to 2022 time period that drove a demand shock. So we did not have a shortage, this housing shortage narrative of 10 million shortage of, it's just BS. We had a demand shock for 3 years of people relocating to Florida, to the Sun Belt markets to get both affordability, and they could work from home, and it all made sense. And this drove prices really, really high in a short period of time. At the same time, we saw speculators come in, the institutional investors, the mom and pops drive prices up to such an unsustainable point in time. Well, now things have changed. Domestic immigration to domestic migration to Florida is down 93% from the peak. And now international immigration, where you get a lot of cash buyers as well, is down 70%. So you have to ask yourself, again, who is the next buyer that's going to be buying this real estate? So right now we're seeing transactions are slowing. We're grinding along the bottom. Those numbers just came out for existing home sales, looking very weak, about 3% down. Inventory is stacking up, and it's not just for sale active inventory, it's rental inventory, because what happens is when somebody goes to try to sell their house and they can't sell it, they become an accidental landlord. Okay. So this is a huge problem when they become an accidental landlord, and ultimately they put it up for rent. Now we have this massive rent supply on top of the build for rent properties that are being built here. And that's causing, prices are getting cut at a rapid rate. And we're going to continue to see this moving forward, because you have to ask yourself again, where is the next buyer coming from? Real estate is priced at the marginal buyer. And if those marginal buyers feel priced out, the middle class is completely priced out, especially here in Florida. If you listen to my last video, we talked about how Florida has a thinner middle class than the rest of the country. We have a lot of hospitality jobs that are minimum wage. We have a lot of other jobs that, are not doing very well, that keep up with the inflation of the assets here, like real estate and all the pricing here. So we have a thinner middle class. We generally get paid about $10,000 less, and the expenses are higher for this state. So the only way that Florida continues to move forward for real estate is getting the domestic migration, getting the international immigration. And that's where we find generally the majority of the buyers for the state. It's not necessarily, people here working minimum wage jobs with two incomes who are just making it by. They just don't have the capital to be able to make that happen. So things are coming to a halt quickly. And again, the middle class is getting completely priced out. I think this is a great chart that shows, what has been happening over the last, couple decades. There's a divergence between the U.S. median home price versus the median annual income. You can see the home prices, this teal chart trending upwards, and the median household income is just going to the wayside. Well, here in Florida, basically it costs $116,000 for a household income to be able to purchase a house, people only make $77,000 for their median income, and it's a huge problem. Now, I know a lot of people say, well, Florida has a lot of retirees, and that's dragging down, the median income. It not really. I mean, it's 22% of these folks are over the age of 62 years old, or boomer or older here in Florida. It's not as much as you would think. And so when you do the math, and a lot of these people still who are that age, they're still working. Okay. So it's not like a widespread thing. It's usually these very wealthy people with second homes on the water. They live in very expensive communities where there's not a lot of land. There's nowhere left to build. And then there's the rest of the people who live on the suburbs in $300,000, $400,000, $500,000 houses, but they just can't afford that anymore. And this only got messed up after 2020. Before 2020 and 2019, these ratios were not that bad. It was bad, but you can just see this just little spike here right at the end where it just pushed the consumer right over the edge and is a huge problem. So the ratios are messed up. At the same time, the middle class, the consumers, are loaded up with debt, right? They have credit card debt. We're seeing record high. Student loans are defaulting. People have to now, start paying their student loans. If they don't pay them, then basically what happens is they get hit on their credit, and then that impacts their ability to purchase. It's also impacting the people who guaranteed those student loans. It's impacting their credit too if it doesn't get paid. Auto loans, we're seeing repossessions at record high because people aren't paying their autos, and we're seeing a lot of depreciation. So it is crazy the amount of stress that we are seeing beneath the surface that hasn't come to light yet. It takes time for this stuff to play out. I see a lot of people out there who just say, you're just wrong, you're early, whatever. Maybe. I mean, look, what we're seeing right now is the data doesn't make sense for the middle class to keep purchasing real estate. Rents are now coming down at a rapid rate, which competes with purchasing. So there's a reason why we're seeing transactions at the lowest levels ever, basically in history, for the population size that we have and the amount of real estate that we have. It's just really slowing down. And part of that is this consumer debt that's loaded up. I mean, we do DTI, which is debt to income ratios. A lot of them, they're either paying cash and they're moving from the Northeast or the West, or what we're seeing is they have like a 43% plus DTI ratio, and they're buying, with 3.5% down FHA, which is where the majority of the stress is. We're seeing a lot of stress in FHA in new construction communities that were from 2022 to 2025, and maybe they experienced some sort of job loss. They're underwater, immediately when they buy the house. Same thing with VA. When they put 0% down, they're highly leveraged at the peak of the market, and then they experience some sort of life event or job loss, and that will ripple through the market over the next few years. Now, I don't think this is going to play out as fast as a lot of other people want it to. I think that the declines, and from my models, the declines will be about 31 to 42% from the peak. Based on my financial models, my investment banking experience, from the peak, that's the level of declines that we're going to see over, it could be 5 years, it could be 10 years, until wages actually do keep up or prices come down, or a combination of those two. And so that's the time frame that I'm thinking. I don't think we're going to have some sort of crash event that's going to happen next year. I think the administration is going to do whatever they possibly can to keep home prices high, and we need to work on housing policy that creates cheaper, affordable housing for folks, and that starts with a lot of regulations that these local governments have put up to prevent this construction to create affordable housing. So and a lot of that is local movements, because people don't want affordable housing communities near nicer or more expensive communities. A huge problem. So we got to figure this out. So I think from a policy standpoint, there are policy solutions to this, but ultimately there's not a solution to this record level of debt that we're seeing across the board with the consumer, who, in my opinion, are just about there, tapped out, and you can start to see the stress of all these consumers start to move up and tick up every single month. And so the direction of Wall Street, it might be up and to the right, and the Main Street is down to the right. And the reason, and that's exactly what we call a K-shaped economy, where the top 10% get wealthier and wealthier and wealthier. The bottom 90% continue to dip down in having their purchasing power, because they don't own assets. They don't own enough assets to keep up with the inflation that's happening in the market and the amount of printing that the Fed is doing. So look, it's getting so bad out there right now that new construction premiums are now negative, which means that new construction homes are actually selling for less than existing homes. Usually there's a 10 to 20% premium on this. And we saw that there was a massive premium of, 38.4%, over existing homes. And now we're negative 1.2%. And so we're seeing a boom bust cycle even across the United States. But the majority of this is actually happening in the Sun Belt, right? The Northeast has a different setup. They have limited supply, but they do have other issues. They have aging inventory, and young people are leaving because the cost of living there is way too high. And so they have their own issues that will play out over time. But the Sun Belt specifically is the one that's going to play out the soonest, especially with the silver tsunami of people who are sadly, going to be passing away. A Harvard study came out and said that there's going to be 48 million baby boomers are going to sadly pass away over the next 10 to 15 years. And that's going to be a massive wave of supply that comes onto the market. About 70% of boomers own a house, and about 70% of those houses actually go to sale or plan to be sold, according to a Charles Schwab study that came out. So there's going to be a lot of estates that will be selling or liquidating their real estate, and 15% of boomers own multiple properties. So you could see this slow drip of existing inventory competing with the new construction inventory over the next couple decades here. That is a factor to put into play. And you have to ask yourself, where's the demand that's going to come in and gobble up that inventory? And if not, how much will prices actually fall during that time period? So again, thank you guys for watching in the chat. If you have questions, I'll take all the questions at the end. If you're just hopping in here, if you need a top real estate agent in your area, reach out to me. I'll drop my email in the notes and in the description of this YouTube video. We help people with short sales. If you're looking for assumable mortgages, we have a specialist for that. We have basically connections across the country. So if you need to use me as a resource or a connector, I'm more than happy to do it. Appreciate you supporting the channel. But here's what's happening now. Okay. So this is crazy to see while you see the stock market go to record highs and then you see the real estate market go the exact opposite direction, because it's disconnected on who the buyer is and what assets they actually hold. February home sellers cut prices at a record rate of 34.2%. Now we're seeing in Jacksonville about 30% of home sellers cut their price every week. And I have the data to back that up, and I've shown it before. But it's a huge problem. So not only are the new construction houses slashing their prices, but you're also seeing existing homes slash their prices too. Again, this is the highest level of cuts since it's been recorded in 2012. And this comes from a Redfin analysis that they release every single month. It's very helpful to see the direction of what's going on in the market. You can see that obviously from 2020 to 2022, we're having record low numbers of people cutting, and now we're seeing the opposite direction. And this is going to continue as sellers start to get realistic and realize, hey, it's not 2020 or 2022 demand anymore. I'm going to have to price my house. I'm going to have to get it in perfect condition. I'm going to have to hire a top real estate agent. By the way, 80% of agents are horrible, by the way. So you want to work with the top 20%. If you want to access the top 20%, reach out to me. I have people, again, across the country. Just shoot me an email with your situation, your price point, your neighborhood, what you're looking for, and we can get you set up for a strategy session consult. So Florida, again, has a thinner middle class. There's this massive report that just came out, said housing costs in Florida, shelter costs in Florida are now 37% of income. And this is what we're talking about. If people in Florida make less income and their shelter costs are higher. This is 2008 level stress, except this time it's happening with higher interest rates and weaker relative wages, because the ratios are completely different than they were in 2008. But this, the market here and a lot of markets here in the Sun Belt, they rely on this international immigration and this net domestic migration to be able to sell these houses at these prices. And if that spigot turns off and these builders keep building and finishing their communities, we're going to have a supply glut that's going to just drive down prices for years until we see that demand come back. And I'm not sure we're going to see that demand come back anytime soon based on what we're seeing. And obviously local governments are going to have extreme stress, because not only are you doing this, property tax proposal, no property tax, but if they see their price of the houses go down, they're not going to be able to collect as much tax there either. And so there could be this double whammy to local governments that puts a lot of stress on them. So be on the lookout for that as well. And here's the study that came out that said Florida ranks dead last for renters in the United States, with housing costs consuming 37% of incomes. I'd love to hear from you. What are your housing costs? What percentage of your income, and drop it in the as a comment or in the chat, what percentage of your income goes to shelter costs, and where are you coming from? Love to hear what you're seeing. But this affordability crisis is real, and it's getting worse every single month. Again, the top 10% in the United States own 93% of the stocks. And so days like today, where you see it ripping up 1.3% or higher, it's really bad for, it's not great for the middle class, the bottom people. It's a sentiment gauge for Wall Street, not for Main Street. And there's a huge difference between the two. Now we're getting this narrative from the White House, and it's constantly getting it wrong. This is an image of Jacksonville, Florida. You can't even see the name of it, but there's this housing shortage narrative that's going on, which is crazy, because one thing to think about too is these new construction communities, they generally only list in MLS 1 or 2 of their models, and the rest of them are offline. So you're not even seeing the full picture of inventory that's out there in the market in areas where in the Sun Belt, where the builders just went crazy and built a ton of inventory. Most of these shortages also don't address all of the accidental landlords that turn their house from a primary residence into a rental property, and the rental supply is also moving up. Also, it doesn't take into account all these multifamily properties that have been built, and we're completely overbuilt for multifamily. So, we see these random narratives come out. I don't know why, but the White House seems to constantly be getting it wrong. I know the White House was very, very engaged in trying to find a solution to solve affordable housing without letting prices come down. But prices need to come down. I know they said the 50-year mortgages. There's tons of issues with 50-year mortgages. First, rate would be higher, so it really makes no sense to do that. And the amount of interest you would pay over the 50 years is just massive. We actually need shorter mortgages to promote ownership versus mortgage ownership. So those are two very different things. Assumable mortgages is a cool idea, but the financial markets probably won't accept that, and there'd have to be a lot of laws changed. You probably have to do this through Congress. And then portable mortgages. I like the ideas, right? But it's how do you actually execute it? And is it just talk, or is it something that will actually solve problems? So one of the things that you need to listen to is, there's a lot of talk, and this is true with any administration. What are they actually going to do to solve it? Well, one of the best things you can do in a market like today is nothing, and just let the market be free and reset. Now, people who own a lot of real estate won't like that. But people who are the next generation, the 90%, and the younger people who are just coming into the job market who want to own a house and don't want to rent, the math no longer makes sense for them. Okay, they can rent the same house for $1,000 to $1,500 less than it would cost to get them a mortgage at today's rate at a high LTV, and that's a huge problem. The math has flipped. When I moved to Jacksonville, Florida, I could get a mortgage payment for $1,200, $1,300 and the house was $190,000. That same $190,000 house is now $450,000 at a 6.3% rate. And, you have over a payment of $3,000. The math no longer makes sense because the wages, are still, the median household income is still like $68,000. That you just can't afford it. There's just not enough meat on the bones from the middle class. The only people who can buy are going to be speculators, investors, or people relocating here domestically or from international immigration. And it's a huge problem. But I don't like any of these solutions right now. A lot of the other issues include we're not building enough affordable housing and price points that the next generation can actually purchase and rent. We're building luxury apartment complex. And I don't blame the builders for doing this. They want to build it. They make 10 times as much money on a $700,000 house than they do on a $250,000 house. And it takes about the same amount of work for them. So I don't blame them for doing this, but we got to find a path to incentivize builders to build in price points that actually will help the middle and the bottom class. So that way they can move forward and we can have a healthier market here in Florida versus this boom bust cycle that we just keep seeming to go through. It's a really big problem. And it's something that, I'm passionate about. So we'll see what happens. I'm speaking at the housing policy conference down in Tampa next week, which I'm really excited about, to connect with some other top real estate people. So, shout out to the team there, and I'll release some more information after that event. But it's great to network with other people and try to find housing solutions, because what we want in Florida specifically is a strong middle class, so we don't go through these boom bust cycles like every 10 to 20 years. Now, here's what's also happening right now. You're seeing stale inventory stack, a record high for February. These are houses that have been on the market for 60 or more days without going under contract. And again, this is another record. This comes from Redfin, $347 billion of real estate. So there's a lot of capital on the sidelines, right? We just saw $7 trillion flow into the stock market in the last 13 trading days. And that, they could have been buying real estate. Well, why aren't they? Because they don't see it as an attractive asset class at this point in the market cycle. So we're actually seeing the opposite happen. We're seeing stale inventory stacking. So, while we see the administration say we have 10 million, how can you have 10 million houses short, and then you have stale inventory at record highs, and then the amount of cuts to pricing at record highs as well? The narratives just don't match. So it's one of those things that, I think it's very regional. Even Florida is like 5 states in one, but the Northeast is completely different because they just don't allow the construction, as much construction there. They have the not in my backyard folks, and it's been a huge issue up there because of the regulations. But here in the South, the South, it's a completely different narrative, and we are seeing the inventory stack up and prices come down, which is exactly what we need to do. Obviously, this is freaking out investors, so they're pulling back on construction. They're pulling back specifically on multifamily. This is quarterly deliveries in the United States. Q1 2026 supply comes in 53% below the cycle's peak, and we're starting to see it kind of level out for the amount of inventory that's coming in from multifamily. But they're pulling back because they're starting to see the situation. I don't know why they didn't see the situation happening before. I guess they thought that demand shock from 2020 to 2022 would be going on forever, which is mind-boggling to me, because real estate's extremely cyclical and it's based on fundamentals long term. Just like the stock market, it always comes back to what we call mean reversion. We will have a mean reversion period for areas that just get over speculated and overhyped, and that's exactly what we see here happen in Florida, and it's a massive problem. Of course, because they overbuilt, now we're seeing apartment rents declining. And when apartment rents decline, you see the single family rentals decline. When you see those both decline, you have to see house prices come down, because it only makes sense for the speculators to come in at a certain cap rate when they go to buy those rental properties. So then you see the prices come down, and then you start seeing it all kind of rotate downward in this downward spiral that we're seeing, unless we see some sort of mass demand. But the demand is not going to be coming from the middle class because of this affordability crisis. Even if we see rates, I think, go back down to 5.5, we'll see some sort of short-term jump from those marginal buyers to come in. But that demand gap is still there, where it still makes sense to rent in a lot of situations than it does to buy, unless you're going to be holding the property for 7 to 10 plus years. It really doesn't make sense. The average person stays in their house about 8 to 10 years. That's why the mortgages are tied to the 10-year treasury rate. But, in the first 10 years, the majority of the payment that you make because of the amortization schedule is going to the bank in the form of interest. You're not really getting the benefits of that principal pay down. And you still obviously have maintenance drag on the house, which is the amount of, it's usually like 1% to 2% per year. You need to keep the house updated. There's costs associated with it, not just taxes and insurance, but the repairs, upkeep. A lot of these rental apartments, you have to turn each unit, can cost $2,000 to $5,000 depending on how much damage is done to it. And now there's just an oversupply. So we're seeing a massive supply come on. That's why you're seeing apartment rents decline for now 3 years. 2024, 25, 26, we're seeing a decline. So we saw this massive bump because of the demand shock, and now we're seeing it quickly come back down and go negative and reset. And this is, again, a very good thing. So if you're a renter, you are in control of the market at this time. So I'd love to hear from you. If you're in the middle class, how are you feeling about the market, the housing market, where you are? If you already bought, didn't buy, thinking about buying, things like that. If you're a seller, I'd love to hear from you too. Are you thinking about selling? And what are you seeing on the ground in your market? So what I'd like to do now is I'll open it up to the chat and answer any questions that you have about the real estate market. I'm obviously in Florida, but I have friends in real estate, commercial real estate across the country, and know many of the markets of what's going on, because this is one of the things I'm passionate to do. If you don't know me, my name is John Brooks. I used to be an investment banker, a real estate investment banker on Wall Street. And then I became a real estate agent, top real estate agent in my market here in Jacksonville, Florida. Then I opened a real estate brokerage. I flipped homes. I've owned multifamily homes. I do investing. I do private lending. I give loans to agents to do fix and flip loans. And I've been reporting over the last, 6 months of what is going on, 8 months, what is going on in the Florida real estate market, because I don't think people are telling the truth of what's actually happening here, while these mainstream media companies are popping out false narratives to get buyers who don't know any better to purchase at the peak of the market and get this overpriced builder slop onto somebody else's hands. And I feel bad for those people who are buying these stick builds at record prices. That person who bought that Lennar house for $500,000 in 2022, it's now worth, $375,000. That's exactly what we're talking about. If they'd have watched this channel, they maybe could have thought about it differently, negotiated better, had an opportunity to see where we are in the market cycle, so they can make the best decision for themselves. So this is just information. It's not financial advice. You make the decision for yourself. But this is just what I'm doing. So I appreciate you guys watching, and I'm going to be opening this up to the group so we can go ahead and get some of your questions answered here. And I'm going to drop my email here too. If you have a question, I respond to every single email that comes through. The more specific you can be, the better. I'm happy to respond to everybody. I haven't missed an email yet. If you're looking for an agent, you just need help on something, that would be great. So housing in Ohio in most parts sits for 60 days plus. Well-priced homes still sell fast. So yeah, we're seeing the same exact thing happen here in Florida. If it's well priced, it's a unique product, and it's in great condition, they're still getting gobbled up. But the problem is the majority of them are not. A lot of them need like $30,000, $40,000 of repairs, and the sellers just don't have the money to do it. So that's a huge problem. How and who are affording these houses? Do you have stats on this? Thanks for all you do. But yeah, so one of the stats that we see out there is that the median home buyer today is basically 60 years old. And who they are is they're somebody who owned a house, bought a house 20, 30 years ago, and now they're selling their house and moving somewhere else to either be close to family, work, whatever, life change. And they're using the equity from their prior house to buy their new house. And they're either buying it cash or they're getting some portion of it financed. That's the majority of the buyer. You see the first time home buyers be at a record low of the share of around 21% of the buyers are first time home buyers. So it's really low for the first time home buyers because they're simply priced out. They are loaded up with debt. They're priced out of what's happening on in the market. And so we're seeing a lot of these issues, around that. So the first time home buyers age is now 40 years old, which is 12 years later than what we've seen previously, around 28 years old from just a couple decades earlier. So these are great questions. There's a lot of stats on this, on who the buyers are, but in Florida specifically, the most of the buyers we're seeing are from other areas that are relocating and coming with their wealth already baked in versus the middle class that is primarily priced out. So they might be able to scrape together, two incomes to be able to purchase a house. But, again, at the peak of the market, it's a really hard time to do it. And there's a lot of concern about job loss too. So those are huge issues. So Austin, hey, somebody sent me $10. You don't have to do that, but I appreciate it. You guys are really, I didn't even know that was a feature until a little while ago. We're Westchester and Northern Jersey are now going well over ask because of insane economic policies being forced on 10 million people in New York City. Great work, John. Thanks, Austin, for the take. And, look, New Jersey and New York City, it's a very different market. It's a very different type of market. You almost can't compare them. That's why I think the national stats are kind of BS. I don't like when people put out, well, this is what's going to happen nationally. The United States is 50 different states. There's extremely different economies. It's hard to compare. Even Jacksonville is like 5 cities in one. There's the beaches, there's West Side, there's North Side, there's South Side. They all have completely different demographics. They have different jobs. They have different amounts of new construction. And, Jacksonville is the largest city by landmass. So when you're looking at, comparing the South to the Northeast or even blending them together, it doesn't even make sense. That's why you need a local specialist for your specific market to tell you what's actually going on. So let's see, Patrice. John, I'm hearing you say that the housing market will no longer decline in prices. I'm listening live and just heard you say I thought it still needs to be a 20 to 30% decline in the Sun Belt. Yeah, so I have a financial model that I have from investment banking, and I ran it, and I said, what would the investor be for the backstop to start purchasing houses again at today's mortgage rates and today's prices? And the math showed me, depending on the area and the taxes and insurance, that prices of a retail house would need to drop between 31 and 42% from the peak of October 2022. And this obviously is a crash, right? Anything over 30% is a crash from the peak. Anything 10% or over is a correction. Well, a lot of areas of Florida are already in a correction. And I think there's going to be, in a lot of areas, even in Colorado, Arizona, Texas, they're already in a correction, headed for a crash. Now, I don't think it's going to crash overnight. That's not how real estate works. It's an illiquid asset. It takes years and years to play out. It's a different type of asset class. The sellers can be stubborn, buyers can be stubborn, transactions can slow for a significant period of time, which is what we're seeing right now. So, I'm not one of these doomers that think it's going to crash overnight. If there's some sort of wave that makes people more productive, earn more income, get more wages, I think that's great. What we're likely to see happen is a combination of prices coming down another 10 to 20% from here. And then we're going to slowly see wages keep up, and then it's going to steady out. So I think, but again, it depends on where you are and where, like, how much new construction is around your community, how much speculation happened around your community. The more speculation, the more new construction, the harder it's going to fall because the numbers just got so far away from the fundamentals. A lot of that happened in Florida and Texas. Some of it happened in Colorado. Some of it happened in portions of California. It just depends on your individual market. And so there's even pockets of Florida that have had no impact from what's been going on because they're completely insulated because they're part of the K-shaped economy. They have very wealthy people who live on the water. They don't experience it's distressed, they don't care what the market's doing from day to day, going up or down or year to year. They're going to own that real estate regardless. So it's one of those situations where what I'm tracking is the middle class. That is the majority wave of buyers, because the speculators in the Sun Belt have mostly disappeared because the numbers no longer make sense unless they're finding super distressed stuff. And then those become the next comp, which makes it harder for other things to sell. So I do think that we are going to see another 20 to 30% decline moving forward. I'm not sure what the government will do to try to solve that, but we absolutely have a supply glut in Florida, which is so crazy to hear the White House come out and say we have 10,000 shortage of 10 million shortage of homes. There may be some shortage of homes in the Northeast, but what we're really talking about is there's a shortage of affordable homes that people can actually rent and actually live their life on and have enough money, what I call surplus capital, after paying all their expenses, to live and invest and get out of, climb the financial ladder out of the middle class and into the upper middle class. I just don't, it feels like the bottom rungs, the rungs are getting chopped off the ladder, and it's becoming harder and harder for people to climb the ladder, especially young people when they're coming out into this type of market. So I'm thinking what's going to happen 10, 20, 30 years down the line. Birth rates are near record lows. I think it's like 1.2 right now. That's a huge problem for Florida still. The middle class is getting squeezed with debt. Who is going to be the next buyer who's going to pay these record prices at these kind of normalized interest rates at around 6.3%, a little bit below the average. So it's something to be thinking about. It's a great question. West Lafayette, Indiana, 30K price cuts on 500K houses and lower, still hard to sell. Yeah, I mean, there's areas like India, like there's areas that don't have the boom bust cycle that are still seeing this type of stress. Aiden, I wonder is there a lot of new construction around your area? Was there a lot of speculation, institutional buyers? That'd be great. Is Wall Street still a net buyer of homes? I've heard some are net sellers like American Homes for Rent. Michael, that's a great question. They are a net builder of homes. So they're building the build for rent, but they've been trimming their existing portfolio. So they're net seller of their existing portfolio, but they're building build to rent. And they can do that because they have economies of scale. And I think build to rent is great. I don't like the legislations out there that's going to stop or prevent or make it harder for these build to rent products to come through. I think it's fantastic. Let them supply, like put a ton of houses there and get these rents down, because we need more supply. So yes, the Wall Street is right now a net seller of homes. They're mostly doing it by trimming their portfolio, their weakest assets. They'll sell, whatever, 10, 15 a month in each market of the worst performers. They'll keep the best performers. But again, they do pretty well. I mean, if you look at American Homes for Rent net profit margin, there is still like 17, 20% profit margin on the houses, but they benefit from the economies of scale. They kind of bring everything in house, but it's really hard to work with Wall Street. I hear the complaints nonstop. It's very hard to get in touch with a human. You have to do everything online. You have to apply. They're trying to automate this process that is a manual process that people are used to, and they're trying to make it where you can't even ask questions. There are ways to still negotiate the rents with these Wall Street companies. You got to, if you need help figuring that out, let me know. You can always email me. I'm happy. I respond to every single email, and I don't expect anything in return. I'm just here to help people win. I want to see you guys win. I want to see you make a lot of money. I want to see some awesome results, and appreciate you guys following the channel. They have like heaps here in the southern middle Tennessee with available signs in the yard, but only one or two listed on the Lennar site. Yeah, that's right. So these builders do not list all of their inventory. So there's a shadow inventory behind the scenes. We're also seeing what's interesting, we're seeing these workout programs that happen from 2020 to 2025, which is, someone is delinquent on their house. They move the workout payment on the back end of the loan, and we're trying to close these deals. The title that they forget that they had these loans they thought it was free money from the government, these sellers, and then they go to closing and they find out they have an extra $40,000 on the back end of the loan. And then it kills the deal, and the buyer gets screwed too. So we're seeing a lot of interesting things. We're also seeing FHA folks and new construction community, FHA delinquency is 13% now. So FHA is kind of like the new subprime. There's about 8 million FHA loans out there, and 13% of them are delinquent. A lot of them are underwater. There's a great guy to follow. His name's John Comiskey. And so if you want to follow him on X, he's got all that data, and he also has a paid Substack that they can listen to. He reports that data. Current development and building seems like slow motion blow off the top, just takes so long to play out. Yeah, right. Because developments can take 3 to 5 years to finish. So a lot of these builders thought the demand would continue, and they got their financing in place. They got their contractors in place. They got everything in place. And then of course, it takes, years for these developments to finish, and they have to finish the development. Once they got all the contracts signed, everything moving, they have to finish. Now they have like tons of supply moving into a very weak market with declining rents and declining demand at the same time. Also, like Austin says, certain areas are being held up by those escaping areas that have been destroyed by welfare Section 8 mortgages from the past 4 years. I'm not sure what that means. If you can post, Alma, what you mean by Section 8 mortgages from the past 4 years, that'd be great. Thanks for providing value. Yeah, happy to share what we're seeing on the ground. So again, I don't have an agenda here. I just want to see people. I'm just sharing what I see, okay, and what I'm seeing. So it's oh, I'm also a Pokemon champ sports fan. Yeah, you can see the Pokemon stuff behind me. I was the world champion for and I played, in Hawaii at the Tropical Mega Battle. So I'm an obsessive person that loves data, loves tracking, likes figuring out what the next move is. And I've been that way since I was a kid. And then I played Magic the Gathering, now Lorcana. So again, strategy is really important. It's a lot of characteristics that overlap with what we see happening in the real estate market, running a business, right? Tracking every metric, making moves, trying to figure out what the next move is going to be, analyzing the playing field to make the most optimal decision. So tracking all those KPIs to make the best decision is really important. So it's very good. Card games, if you can get your kids into card games too, I'm going to get mine into it. It's very helpful for business, and it's helped me a ton in real estate. Does your model factor in macroeconomic conditions such as a recession or high employment? No. So that's a great question. My model is simply where would prices and rates need to be and rents need to be in order to have an investor come in and step in and purchase the real estate. So prices could absolutely go lower. Like, for example, my model does not indicate that, rents would also go lower. So that's another thing that would go into the calculation. I'm building just a simple, I feel like the best models are where you can just explain it to somebody like this, and you have your key variables that explain 70 to 80% of what's going to happen next. That's how I run my businesses. I'm focused on the primary drivers, the primary variables that'll move the ball forward. Anytime I think people add a little bit too much complexity to their financial models, and then it just becomes something where it's really hard to understand. And also I think they honestly sometimes have worse outputs, because there's a lot of things that you could think are important that then just become distractions. But in real estate, we're looking at supply, demand. Like, all you need is the price, the rate, the payment, the rent, and then you can do the math on, okay, what would I need to get as a return versus other assets? And then what would I need to drop the price by in order to get that type of return? That's the way that I view it. I think it's a great question. There's tons of models out there. This is just the one that I've developed, and I think it's really important. Yes, I reply to every email. Thanks. John, I'm California. The main reasons I can't buy a house is the ridiculous high prices. Yeah, California, 1 million median price in the Bay Area and zero job security. Just got hit by a layoff in January. Sorry to hear that. Hope you get back on your feet soon. You're not the only one. There's a lot of people, especially with AI, there's going to be a lot more job cuts. And I think, obviously, if you don't have a job, you can't buy a house. So that's going to be something that, we could see move the other direction too, is if there's some sort of job loss or replacement for a period of time while people transition into other jobs, they're just not going to be buying real estate. I mean, a lot of people, they move out of California that, even the taxes there are really high. If there's zero job security, that's a huge problem. But obviously it's one of the most unaffordable places to live in the United States, and you're there by, probably by choice. So you always can vote with your feet. I grew up in Washington, DC. I graduated from Virginia Tech, top of my class, and I moved right into my parents' basement, even though I had a Big Four quant job as a tax policy analyst, and I was making $55K. You can't live on $55K in DC after the cost of living, the taxes that you have, like everything. It's you work that entire year and you have nothing to show for it. I had to get up and move and vote with my feet, and I moved myself to the second most affordable area in the United States in 2014. And that was Jacksonville, Florida, where I am right now. So it's something to think about. You can vote with your feet and try to find somewhere that does make sense. And the numbers back then did make sense. Now they don't make sense. The numbers are completely whack. It doesn't make any sense. A lot of these hoods would have been abandoned by now if 2008. It means how they were giving away mortgages and letting people live there for free. I think Section 8, you basically, the government's paying them to live there for free. So it is, I have a video actually on Section 8 that analyzes, it's like my third video that I ever did on YouTube that analyzes all this Section 8 stuff. I used to own Section 8 apartments actually, so I'm pretty familiar with the process, getting funding from federal, state, and how they administer it locally, and how they have to do all these inspections, and how it's like it's gamified, where you're trying to find the highest rent that you can with the best tenant that's not going to destroy your place. It's a very interesting thing, but I don't know anything about giving away mortgages to Section 8 people, but I do know the government is basically giving them these vouchers to live there for free. And a lot of these people, need it. They actually do. They need some help. They've just had some hardship. A lot of these people do not. And I think that's where people get frustrated is, I'd probably say about 30% of the people are living in my apartments. Like, there was no reason why they were getting a voucher. They were totally fit to work. They could work. They could get a job and make that happen. And I'm not sure how they got on the voucher, but is there enough accountability for the voucher system? I think it's a very fair question, because it's frustrating, because some of these apartments are like luxury apartments, especially in like California. You can get like $3,000 to $5,000 to get a voucher to live in I mean, it's like unbelievable that's our tax dollars that's going to this stuff. And it is frustrating for the average person that works really hard and then pays their own way. Wall Street needs to be completely removed from the single family home market. Steve, I get that sentiment. I understand it. It's not, to me, it's not Wall Street's going to do what it's going to do to find ways to maximize returns. If I was going to go after somebody, I would go after Congress for nonstop spending, and I'd go after the Fed for constant financial manipulation of mortgage interest rates that caused this wild speculation. I don't like, I think the market being free is the best thing. If the government can just stay out of business and let these things work through the system, we'll eventually come to a really clean market that's healthy. Right now, it's completely manipulated. Housing is one of the most manipulated markets out there. And Wall Street just takes advantage of that because they're smart. They have the data. They're making really good decisions. And they've been able to benefit from that. I'm not saying, but Wall Street also, you have to understand, brings in tons of capital where we get build to rent product and they overbuild. And then we benefit from having new product, brand new developed product that's on the market. That's great long term for our local government. And then you get, they get tax revenue too. So I don't like the idea of banning Wall Street for single family homes. And also Wall Street owns the institutional investors own less than 4% of the supply of rental homes out there. It's the mom and pops. So it's like, are we going to ban mom and pop? Like, it's 90% little mom and pops who own 3, 4, 5, 10 houses are the ones that are really owning the majority of this rental stock. So if you're going to be frustrated with somebody, look at those folks, not Wall Street, because Wall Street is just a speck compared to the mom and pops. And again, it was all manipulation by keeping the zero interest rate policy in place for such a long time, right? They just kept it at zero for way longer than it needed to be, and it created all these distortions in the economy that we're all paying for now. So I think it's a huge problem. Giving mortgages to people who wouldn't qualify for one otherwise. Yes. So the local governments are wild with this. They have these little programs to do down payment assistance, et cetera. They do it at the peak of the market. And look, I understand the sentiment. You want to help people achieve home ownership, and home ownership is viewed currently as the American dream. But the truth is that, a lot of these people, they default on this stuff, and it ends up being a problem down the line. So I think it is a risky business to be in. And I don't think that the government should be giving mortgages to people who don't qualify for them. So I do agree with that standpoint. As regards to it being related to Section 8, I'm not sure. I haven't heard of that. Mandatory limit on the number of single family homes an individual investor can own, needs to be done also. Steve, I understand that. Again, if we Steve, there's other ways to solve this. I just had John Wake on the other week. His idea was, why don't we just get rid of all these incentives from a tax perspective for investors? And that would immediately solve this problem overnight, because a lot of these people, they use the real estate as a way to decrease their taxable income. And if they just fix the tax code, then that'll stop those massive investors from coming in and mom and pops from buying single family rental homes. I think that would mitigate a lot of it, and that would create a lot more inventory that would be available for people to buy. So I think there are policy solutions to this. Will the government ever do it? No, because they're not going to lose their entire investor base of donors and everything, and that's why you need to get the money out of politics. They're just going to continue to drive as many tax benefits to the wealthy, because the wealthy are the ones that are given the benefits, and young people and people don't vote. You got to vote if you want a different outcomes. You got to vote, but we also got to find better candidates too, because that's another huge issue. But I think a lot of the problems that happen in real estate is the nonstop manipulation from the Fed and the Congress just overspending. Our dollar is becoming worth less. This inflation that we're experiencing, and it all combines together into feeling like we got to stop these mom and pops. We got to stop the Wall Street people. It's like, well, what's the incentive that has been developed for the mom and pops in Wall Street to buy? Is the low rates, right? So like, who's in charge of the low rates? Why are we doing that? So that's where I think we get to the bottom of the main issue, because I can tell you, if rates were 10%, we would not have this problem, and prices would be a lot lower, and we would have a better entry price for the next people who are looking to buy. And I think we're at 10% is where we would be if we didn't have trillions of dollars on our balance sheet of mortgage-backed securities that we bought to manipulate rates lower. So it's something to think about. Getting those people in the areas they don't belong. Capital controls is not the answer to curb speculation in the housing market. Get rid of bailouts. Our investors are too happy to take risks when they're guaranteed bailouts. Yeah, yep, I agree. I don't think we should be bailing out anybody either. So look, I love spending this Friday with you. I'm going to go hang out with my family, but I hope you have an awesome weekend. I am turning 35 on Sunday. I'm sending out an email tomorrow morning that is from my Substack, my 35 lessons from 35 years of living. I would love for you to be on that email list. It's johnbrooks.substack.com. You can also find it on my page, and get on that list. I send out 2 emails per week of real estate information geared towards real estate agents, investors, all that kind of stuff. So if you're interested in real estate, learning more, connecting with me, go ahead and do so. I love this community that we've built over the last couple months here, and being able to connect with so many of you, and grateful for all the referrals and business that everybody has sent me. This means a lot to me. And, I hope you have an awesome weekend, and I'll see you next week. My next video comes out on Tuesdays and Wednesdays, usually around 2:00. My videos come out, and then I do a live Q&A on Fridays. Tuesday next week, I will be again down in Tampa doing some housing tax policy work with some legislators, which is kind of cool to try to see if we can get in on that conversation. That is the power of YouTube and X. You can also find me on X at John Brooks. So thanks again, and have a wonderful weekend, and lots of happiness to you and your family. See you later.